What you're going to see is the stress test gets harder and other regulation gets softer. And that's going to be the combination that we see going forward. I think, these stress tests are not that hard to pass if you recognize that once in a while you will get these major shocks to markets and to the economy.
The idea that so many of the banks that ran into trouble did it because of the one-off implications because of the tax law changes. Is that valid concern from the banks saying, hey, this hit us at the wrong time, or is that what you should expect if there really was a financial crisis?
Yeah, Leslie and I were talking about this in the green room. I mean, I suppose that you could argue that, but it's a bit of a puzzle because the tax bill was pretty well telegraphed. I think that people now are realizing that these stress tests are getting harder and they need to take them more seriously.
I think a lot of critics are looking at this and they're saying, if there was a financial crisis at this point in time, based on the stress test as it was hypothetically tested, Goldman Sachs and Morgan Stanley, would be subjected to the same kind of stress and pressure, regardless of the tax law or not. So why give them a break?
Although maybe, if you were going to go from where we are in unemployment right now to 10%, you would guess that Goldman Sachs and others would see the change coming and would start to position a little differently. You don't go from 0 to 60 overnight. Maybe they would see the signs and would change their positions accordingly.
Yeah,
based on how they performed.
But remember, and it's almost 10 years, there is this notion of a sudden stop. That's what happened in September of.
It was a sudden stop, but there were a lot of things, a lot of warning signals along the way. I would argue it was much worse than anybody had anticipated.
Relative to 2008, I think the banking system is much, much stronger. And in fact, if you're going to do a stress test, it should be of non-banks. That is where risk has migrated and morphed. So the non-banks.
So who would you be stress testing right now? If you could be regulator for the day, how would you expand the stress test?
So I would start focusing on the non-banks. I would start looking at the asset management companies, for example. There's been a lot of new vehicles that promise instantaneous liquidity on asset classes that are inherently illiquid.
ETFs?
So there's ETFs in high yield. Do you really want to offer ETFs in high yield? What are you telling investors?
There's ETFs on everything, Mohamed. Now.
Yeah,
no, more ETFs than stocks.
So play the dominoes out.
So the dominoes would be
the dominoes in the ETF market. What do you think really happens?
So people enter an ETF because an ETF promises you instantaneous liquidity at reasonable bid-offer spreads. There's a major shock to the market, and they find that they cannot get that liquidity. What do? They sell something else. That's what people do. I've seen it over and over again. As they sell something else, you start getting financial contagion. As financial contagion spread, you get the risk of economic contagion. Now, I think that probability is low, but the regulators have to focus more on the non-banks.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.